Hello, welcome to the tutorial for the RTV indicator, right? Rational technical value. So I'm going to try to make an all-encompassing video on rational technical value, kind of testing shift in my mic versus the tutorials I did on the portal. So hopefully this comes through a bit clear, more volume, and hopefully there's no downside to the change that I made in the audio. But with that being said, this is a futures asset, right? This is basically small caps futures. But the asset doesn't really matter because this is all based on technical value, which is different than fundamental value, right? So, or intrinsic value. So I want to kind of make that distinction before we start, right? So this is basically kind of looking at historic technicals. It's also in the dashboard up here, kind of looking to consider the type of asset it is, right? As far as what is its volatility profile. Bitcoin, for instance, has a significantly different volatility profile than the S&P 500. Even though many people would agree the S&P 500 can be volatile, it's a pretty big deal in the S&P 500 if we have like a 1.5% move. In the world of Bitcoin, that's really like nothing, right? 1% move in Bitcoin, we can all agree, is nothing. Ethereum, same thing. So that's why the settings for the dashboard actually matter, right? So I want to kind of share that. You can double click the indicator itself, or you can go over here, click, find the settings, and make adjustments. So this is RTY, like I said, which is a futures asset for small caps. So I click here, and I just want to make sure that the asset class is appropriate, right? So this controls the dashboard, and it just makes sure that what's on the dashboard is reasonably accurate, right? So since all of these have different behavior, different volatility profiles, I want to try to find the one that suits the asset I'm working with to the highest degree possible. And if you're not sure, you can always use AI to kind of ask. You could even copy this and paste it into AI and say, which one of these would be best for a gold miner, right, on average? Or you can ask in the group chat. But with that being said, I want to just kind of start with how it works, right? So I'm going to click this. And so now all of this data, which it was already set correctly, but now all of this data is correct for the asset that it is, right? RTY, small caps, Russell 2000, futures specifically, right? It's accounted for all those things. So now we can kind of look at it and use it for what it is a little bit more appropriately, right? So we can basically look and we can say, okay, we're pretty extended from this midterm number, which is about 2569 right here. And we can see that we're even a little bit extended, but not much, from the price on the short-term time frame, right? So that's why it says short-term time frame, right? 2717. So we're a little bit ahead of that, right? So that's kind of where we're at. And as you can see, it might be just consolidating, making its way toward the short-term, time frame. And it also, in the case of a more significant correction, at any point in time, we have to kind of consider, is an asset maybe in a place where it's correcting and moving toward its midterm rational technical value, right? So that's kind of another consideration. So it kind of helps us identify situations where if the asset is way up here and it's super overextended, it gives us a bit of perspective on how overextended is it from the midterm. How overextended is it from the short term? Is it overextended from both? And so forth and so on, right? We have all of those different things that we can kind of grab from it. Now, I'm going to get a little more nuanced here and kind of show you a few things, right? The other cool thing about this data, and you kind of have to watch out for these, right? Because this is kind of like the get ready to short, right? Or get ready for a momentum trigger to occur. But as you can see, it started to kind of show up here a bit lower, and price action continued upward for a while, continually posting those get ready to have the bearish momentum trigger fire off, right? So it's not that it was wrong, it's just that's why, it's kind of a get ready thing more so than an execute thing. Now, you can preemptively execute, and if you have a long enough time frame in mind and you're okay with that, and if you're comfortable going upside down in a trade and you truly believe that you're going to be accurate, even if you did short here a little early, or even if you kind of shorted here a bit early, just know that if you're trading something volatile or high leverage, this is going to put you pretty well upside down. So you have to be comfortable with that before you attempt to do that, right? And in this scenario, waiting for the bearish momentum trigger might have been smarter, right? Because it probably started to appear here, and then we're going to see how far it takes it. But I think it's important to note that you have historical data on how well or not well these triggers work for any given asset, and I think that's kind of the beauty of it, right? So we can actually differentiate between the large dots and we can differentiate between the small dots. So then we can kind of say, well, when the large dots hit, it actually seems to work pretty well 2 out of 3 times. Here's another one, okay, 3 out of 4 times, and so forth and so on, right? So you kind of get to where you can kind of decide on when it might be prudent to use it as a point of confluence and when it might not be. One of my favorite times to consider using it as a point of reference is when it feels like the asset is overextended, right? If it's overextended by quite a bit of its short-term price or its mid-term price, or even just kind of like textbook support, right? Can we retest that previous high as a new support, and so forth and so on, which kind of coincides with the short-term white line right there. So overextension is a place where you could look for this type of data to see if it might serve you as a point of confluence. And like I said, I want people to understand that there's a difference between intrinsic and fundamental. So intrinsic value means that, let's say we're dealing with an asset. It's a company, and the company intrinsically is worth, I don't know, let's just say this is the company. You do your research and you feel that the company is intrinsically worth $2,050. Well, it's way down here, right? So now it's overextended from what the value of the business really is by a lot, right? And then you can look at the rational technical value and you can kind of draw maybe similar conclusions. And so if you look at both the rational technical value, which is 100% based off technicals and historical price action and reversion to the mean ideology, right? Things like that. Then you can kind of use that along with, okay, we're at the top of a channel in a channel that has all in all, been respected, right? I mean, I didn't mean to do that. But, all in all has been respected. There's no reason to believe that, it's not possible at least that maybe this channel does continue to increase, but that it's volatile and it's going to have its moments of ebbs and flows, even if it does ultimately go up, right? Which has been kind of like the base case and historical reality for the Russell 2000, right? Or in the case of regular ETFs, this would be the equivalent of IWM, right? Basically small caps, Russell 2000 ticker. This just happens to be futures. So you have this data. And now we've also kind of seen that in many cases, we have to be a little cautious of shorting things when we're in a bullish bias wrap, right? Because it's possible that shorts or bearish momentum triggers, should I say, are just a signal for a resetting of shorts, right? And so instead of looking at it the way that we would, we could probably go as far as to say something like this, right? Let's just say fib retracement. This is a chance for me to be cautious on any over-leveraged, overextended positions I'm in relative to this asset. But it's also an opportunity for me to say, hey, you know what? I'm bullish on this particular asset, and I see a nice little bearish momentum trigger. So for me, perhaps that means it's a great opportunity for me to look for my entries, right? And decide which ones I'm interested in. Which ones do I believe will come into play? And which ones do I think are maybe a little too conservative, right? Maybe I believe that this is for this market and for what the PMR might say about small caps, and for what I believe is going on in the world with small caps, and for what the market conditions report for TradFi tells me about small caps. Maybe I disagree and I go, you know what, I'm going to go ahead and I'm not going to wait for these. I'm going to go ahead and kind of consider this one and this one, right? Or a lot of us in the DIIO ecosystem, we try to have the patience for the winner entry and the professional entry, right? And maybe if we want to take part in some of the more aggressive entries, we consider smaller positions just to take advantage of bounces, or higher leverage yet smaller defined risk positions just to take advantage of bounces, right? And then we look at the asymmetry, we make sure that we mitigate our risk, and that's where we use our little tool, right? Our little, let me see if I have it here. I think it's this one. Yeah, let's see, here we are, and then we've got long position. And so here, we might consider which one do I want my first entry attempt to take place at. Perhaps it's this one, right? This is the patient one. I believe that we'll probably see this, right? I think it would be a little FOMO for me to go in higher. And if I believe small caps are going to go higher to new all-time highs, let's just say, then I might set my target a little bit higher just to be kind of conservative. And I'd say, you know what? This is actually not bad. I could even set my stop somewhat conservatively, and I could achieve nearly an 8-to-1 risk-reward ratio. So you know what? That's where I'm going to make my move. And I'm kind of looking at the thesis of, if it goes this far below, I'm going to go ahead and get stopped out, and I'm okay with that. If I get to the point where I'm evaluating how realistic is the upside, I'm going to look at it right here, and I'm going to say, do I think it's realistic that it achieves a new all-time high to the tune of just a little bit above the other? And I'm going to say, yeah, I think that that's very feasible. I don't think that that's overzealous. And then I could click over here. I could start looking at volatility clouds, or if there's no volatility clouds above this, then I could simply open up pressure lines, and I could make my target the next pressure line up. Right? That's always kind of a nice little simple way to look at it. Or I could look at the Bollinger Bands and just kind of see what appears to be kind of a more extended area or zone of the Bollinger Bands, and just kind of set my target somewhere in there. So these are a few different ways that you can achieve a ideal take profit target. So with that being said, you can do that here, or if you're patient and you want to wait for the winner entry, which is usually your first truly optimal entry, then you just kind of have more patience, save your money, save your time, don't worry about smaller bounces, know that you're looking for more of a true inflection, and that your goal is actually to take it from here to here or better, right? And so if you have that goal, then you have to keep in mind, I'm looking for the real final bounce. I'm not looking for the bounce that does this and then comes back down. I'm not looking for the bounce that does this and comes back down and I get to take advantage of smaller profits. I'm looking for the one that I think is the final, and I know that it could go further, but this is my first attempt at trying to find that bounce, and I have some solid logic to do so. And I'm looking for the larger continuation. And I know that it's going to require patience, right? This is a daily chart. You're planning out something that could last, 2 weeks for you to find your entry, right? And then you kind of continually monitor the red flag risk addendum, the PMRs, the MCRs. And if things change in the world meaningfully, such that you want to make it even more conservative because the red flag risk addendum says so, or it says something fundamental about small caps being super dangerous or likely to fall, then you maybe cancel the idea of taking a less aggressive entry, and you just kind of pivot based on that new reality of the data that you found and the logic, fundamental logic that you found in the PMR or otherwise, and you look for something a little more conservative, right? So somewhere in this neighborhood, or the most volatile last line of defense before it's a break-in trend, the 0.786, right? Which we consider a professional entry on only the most volatile of asset classes, right? So growth stocks, maybe volatile, ETFs, this would still be in play. Individual stocks, a lot of times, even Nvidia in certain time frames could easily go to the 0.786, and then that's the perfect entry, even though it's a lot of times, one of the most fearful places. So this is an example of you using AOIE with the momentum triggers, right? The bearish momentum trigger lets you know to expect some downside. You're in a green linear regression channel. You're in a green bullish bias box on that time frame, as well as the 2-day time frame, right? So if I go over here, I can tell just by shortcutting it, which is the beauty of the CCM. I can look at the 2-day, and then I can simply go over here and I can look at the same thing, right? The 2-day, and then I can basically see that's a really beautiful channel, but I see the propensity for downside that it has. It's almost, inevitable, right? It is the trend. So the trend says that it's not at all unreasonable to believe and or to even expect that small caps are probably going to do something like this, even if we're bullish, right? And if it's really aggressive and I'm wrong, probably at least that, right? So it doesn't really make sense to be impatient to the tune where you don't at least expect this. That is the most aggressive case for RTY, right? Or for IWM. I'm sure the chart is similar. And so you can kind of see, did or was there confusion with regard to the triggers at certain points? And so the answer is yes. And that's why you need to find confluence across, a number of different time frames. So now you kind of see what's going on there. You can kind of see what's going on here. See how it was very nice and clear? Once you look at a time frame with enough perspective, you kind of eliminated the noise, right? This was kind of a clear turn to the downside, and it's a bigger dot. And then this was a nice bullish trigger at the bottom of that channel when it finally kind of, shifted into a potential of breaching that down pressure, right? Assume the down pressure was all the way to there, and then all of a sudden it just showed signs of breaching that down, that fierce downtrend that we were in, right? This one right here that we were in for quite a while, however long that was, looks like 2 months or something. That now, because I'm looking at the 3-day time frame, it's really clear. Hey, wow, that was bullish, that was bullish. And it makes it also equally clear that it's very, very feasible for IWM to go as far down as something like that as being reasonable. We can also see that the channel itself is also breaking a little bit, which just simply means it's weakening a little bit. It's not equivalent to bearish. It just means it's weakening a little bit. So we're using all of this data to essentially find and come to the conclusion of where is a decent entry in this particular asset. And this could be any asset. So most aggressive, where you can find some asymmetry, is probably about here, right, as the most obvious one. And here you're taking advantage of short-term rational technical value, as you can see right here, fair value, right? And so it's kind of giving you that idea. 27.18 is fair value in the short term. You are not, if you jump in here, you're not super overextended or anything like that on the short term. If you're looking for more like midterm, fair value, where maybe you've removed the noise of overextension and you don't have to feel like you're overpaying for a position, well, then you probably are going to want to wait till about here, which requires patience. But that's what the algos are built to do. That's what this midterm data is built to do. That's why it gives you the exact number where fair value or approximate fair value based on technicals only can be found, right? So again, if we're dealing with an asset, let's say it's a company, one of my good friends in a group likes to talk about a stock called AMPX, right? It's a drone stock, it's a growth stock, It's got, just interesting price dynamics. So we had been talking about intrinsic value of that stock. If the intrinsic value is lower and the price action is way up here, and you also have short-term rational technical value here, mid-term rational technical value here, macro technical value here. And again, you have the fundamental value of what the stock is worth per share based on what the company is really doing, how much profit it really has, how much debt it's really in, how much runway it really has, what kind of moat does it really have. Then you have a number of different things that are saying it's probably dangerous to long if the price action is up here, right? Like that's what it's for. It's built to protect you against those bad ideas. It's like, no, if you're going to long it somewhere in this zone, right? Where technical value and like the rational technical value, and ideally, if you can get it, some semblance of intrinsic value are in alignment, and you're not just buying into the hype of whatever's going on. Now, if you want to do that based on technicals, you can, as long as you're smart about your position size and your selected leverage, if any, right? Which the more overextended you are, the less you should be looking at leverage. Or if you do look at leverage, you should be doing leverage with a really small position size with defined risk where you can afford to lose it all. Those are really nice, acceptable methods of entering trades. But if you're looking for meaningful capital in a sizable position, then you want to be closer to, let's say, the real intrinsic values here. It's a bull market, and you happen to get into a place where you can jump in a lot closer to the rational technical value on the macro, which, as you can see, just gets visited every so often, right? Here we had alignment. Now notice that, right? We had alignment. You were probably in a I would say either a neutral to bullish channel at the time, but here's a great historical place where all of them kind of collided. And so you could basically see when all of the different rational technical values collided and we had narrative especially, it was a great entry, right? It literally resulted in going from about 2,000 to 2769 in real time. Now this took a while, right? This was literally, middle of 2025, and it was hard to see, but that is where the macro technical value was, and that is where you can literally see where the midterm technical value was when they converged, and you could also see where the short-term technical value was. So here is the short-term technical value climbing, right? And then when it crossed over, boom, you had this nice convergence of all of them. Now, if at that moment in time you were looking at an asset that actually had an intrinsic value that was discoverable, and let's just say you knew that the intrinsic value of that asset is 2,500, that's the perfect setup where you have confluence between rational technical value showing that you're entering in a nice place. It's not overextended. They're converging in a positive way. And you also have the magnetism of, again, if you have accurate intrinsic value, you have the magnetism of knowing that 2550 is going to serve as a magnet, because whatever this stock is, I did the math, I did the research, and based on my conclusions, it's actually worth 2550 a share, right? Again, this is a hypothetical example, but let's just say I did the math and I find out with facts and logic and math that I believe this is worth 2550 a share, and now I see a convergence of sentiment, linear regression being reasonably good for me. Let's just say I had the CCM to work with, and I see rational technical value kind of conspiring to go bullish. And then let's just say I waited even for more confluence, and I waited for the 3-day to go into a bullish bias box, which is this green box here. I waited for that confirmation, right? I did not enter, which means I could have had a more aggressive position, but I wanted more certainty. So I waited for the bullish bias box to show up on the 3-day. And that's where I decided to enter. And even when I did enter, I decided to do it based on Art of Intelligent Entry, right? So let's do that, right? Let's just kind of see what that looks like. So I'm waiting, and this would maybe mean that I'm looking for a relatively solid entry. So this day comes, and I see that the box is kind of opening up. So then the question is, where do I enter? Well, you could argue that the biggest one would be here. And I think that's pretty much what happened, right? People found that it was a strong trend with a nice positive convergence of technicals and reasonable values aligning. We were coming out of, this move here, which obviously this is not a technique to hit the bottom. This is kind of more of a technique to jump into something for a longer term expectation, right? If you want to hit the bottom, obviously we have ways to do that too, and I would want to kind of make that known. I mean, you're just looking for the momentum trigger, right? And so then you knew, okay, I'm playing the momentum game. I'm looking for a reasonable time frame. So I'm looking for the momentum trigger on like the 1, 2, and 3 day time frames, right? I'm not looking for the momentum trigger on 2-hour time frames. That's going to get me beat up. But if I can find it on, decent time frames where I see the asset is stabilizing and I'm just kind of looking for a reasonable sign that momentum is shifting in favor of the bulls, then that's what I would look for, right? So this is kind of more of I'm trying to time the bottom. What I'm also sharing here with regard to rational technical value is more of an investor strategy with a much longer time frame, with the expectation to maybe ride a trend for quite some time, right? And so as you can see, if I'm really looking for entry as an investor, I'm happy with this bullish bias box that showed up. And as a spot investor especially, this would probably be my first DCA. This would be my second DCA. This would be my third DCA. And that's kind of how I would look at it, right? If you want, you could also do one DCA and you could literally set a stop loss as an investor. But this is an aggressive entry, right? In Art of Intelligent Entry, this is our most aggressive entry, the 0.236. And so this is just a place where I have to understand it doesn't ever reward me to be greedy. And so there are a million different assets in the world, right? Maybe not a million, but there's a lot of different assets in the world. And so it's okay if I only get my aggressive entry and this one doesn't hit, and this one doesn't hit, and this one doesn't hit, even if I was prepared for those to hit, right? I can do a lot of things. I can either DCA with real capital, or I can do options trades where I just look for the bounce. I have my invalidation where I maybe sell off the option if it's a liquid enough option and I have the ability to escape it. I have so many choices. I can basically get into a position where I get the potential outcome of a success with a much larger capital position without having to give up, such a large capital position. And I do so by buying options contracts. So if I understand the options game, I know that I can spend probably 1/10 of the capital, right? Or 1/5 of the capital, and I can get in with something like this. I can sell off if it doesn't go my way. I could do the same here, sell off if it doesn't go my way, or just have faith. And here's where I have to decide if I have conviction, and I've been in the markets long enough to feel this way, right? I have to ask myself that. Any given user has to ask themselves that. Do I have conviction that if I enter an option trade here, that it's going to go up, right? Am I comfortable enough with this asset and this chart such that I feel that it's going to go up? And you can see here, we were down in 2023 to 1636. We came down to something similar when we had, this looks like tariff liberation month, right? Where he announced the tariff liberation stuff. And then we came down, nearly to the lows of 2023. And so, again, you just kind of have to ask yourself, what do I believe this is going to go to? And so, in any one of these cases, right, whether it was here or whether it was here, because this was a good entry and I had this bias box to work with, or if I want to get even more sensitive, I look for the 1-day bias box in the same scenario, right? Let's go down here. Let's look at the 1 day. You can see there's a lot more bearish and bullish triggers popping off on the 1 day. But let's say we pull up the 1 day, CCM is loading, and so I get to kind of ask myself, do I have enough conviction that this asset is going to be bullish over X amount of time or days, such that I want to maybe enter a longer term options trade, somewhere in here, right? Or over here where I think we had discussed it, right? We'll see when these bias boxes populate. We'll kind of see what the 1 day looked like, because it's going to be a lot more sensitive than the 3 day, right? So the 3 day made it apparent that this was a decent entry here for more long-term oriented individuals. The 1 day, as you can see, was a bit more aggressive. So you're kind of looking for an entry on the 1 day, and this is where it kind of showed up, right? So you draw the same thing, and you now have a bit more certainty to work with, and it's just a different perspective, a different way to play the game. So you have your rational technical values kind of converging, saying, look, you're actually jumping in at what might be coming off of the true lows of all that fear that the market was just in. Now you have the CCM bullish bias box to work with, right? This is assuming that you've been watching it and you're looking for an entry. You believe in the asset, you're happy, you like the technical value setup. It looks like you're not entering anything overextended or anything truly dumb. I mean, all of these are kind of lined up the right way, right? Short, mid, long term, right about here become apparent. And so now the question is, at what point in time do I enter based on Art of Intelligent Entry? Well, here you can ask, like, why wouldn't I have entered there? There's a good chance that if you pull up the 4 hour, you would see the bullish bias box show up on the 4 hour, and this would have probably been your 4 hour super aggressive entry. I'm almost willing to bet that would be the case. I don't want to do it because I'm still proving a point on the 1 day, which is more sensitive than the 3 day. But as you can see, we have rational technical value showing that we're not doing anything truly stupid. If anything, they're just now kind of converging. The consolidation has occurred, the correction has occurred, and now they're kind of stacking in the appropriate order again, right? The shortest term is on top, the middle term is in the middle, and the macro is kind of now taking its place on the bottom as a base. And now we can kind of play the game of expanding away, which, as you can see, is neatly labeled on even our current price action. So as we look at that, I'm kind of integrating numerous tools here, but as you can see, there's so much patience required to find the right entry, because you could be asking, why not here? Why not here? You could enter here and say, well, why not here? This is the very first day it opened. That could work. It doesn't necessarily mean you'll lose, but if you're looking for the true first entry, you kind of wait for that, for that top to happen. And when it does, that's where you have the opportunity to jump in. I'm going to kind of like go down here and show you what happens when we use this top, right? When we use this top, this was more of the patient entry, right? And this was a great entry for a lot of people, right? And so I'll do it one more time as we shift to the 4 hour. This allows us to have an even more nuanced perspective. This is the most sensitive swing trade perspective that I will generally utilize. And so here we are, right? This is literally showing you the perspective from the 4 hour. We've identified, the clear starting point, kind of like right around here. We've identified the rational technical values, right? So regardless of the fundamental value of an asset, these are just based on rational technical values. So we've identified that. And then we're going to see if I'm accurate in that somewhere in here is where we probably had the go-ahead on the 4 hour time frame. Maybe somewhere in here, if I had to guess. Maybe the 4 hour time frame kind of opens up way down here, and then you kind of ask, okay, well, what is the best entry on the 4 hour time frame? And so starting with more of a macro starting point, going up to kind of a macro or like a midterm, we'll say midterm starting point, midterm apex, and then boom, right? It goes to the patient entry. Now, would you have been wrong for entering more aggressively? No, but you'd want to be lower leverage or no leverage, or willing to go through some volatility, or maybe in an options position, because as you can see, there's always room for it to go to that patient entry. And we wouldn't call it a winner entry if it didn't go there a lot. So you have to consider there's always room for an asset to go to a winner entry, and then lastly a professional entry. The more volatile the asset, the more potential it has to go there. In this case, it was just such a strong move to the downside, right, for like 2 months straight, that when it did finally whip up, people jumped in, a bit early, right? The red and the orange kind of got some nice entries, regardless of how you looked at them. So in this case, orange was pretty good. But as you can see, we had some chop, right? Because the bullish bias box didn't stay open smoothly on the 4 hour. So you kind of have to use some nuance there and just consider those things. And I think that's why, a lot of times the 1 day is a good one to work with. But if you're looking for entry and you feel like it's going to line up with larger time frames, the 4 hour is very powerful. So mostly I wanted to kind of share that this gives you a bit of a dashboard on extension, but the settings have to be correct. Otherwise, you're going to get, if you have Bitcoin settings in this and you're looking at, an ETF, right? Let's just say you're going to have bad data in here, right? It's already challenging to estimate the data correctly in general. But if you have improper settings, the dashboard here is going to give you, bad data. It's going to say like, oh, you should long right now if you have, mega cap, for instance, in your settings, and you're looking at a altcoin crypto, right? Because this is going to be set on completely different parameters. So that's what that is. Gives you an idea, kind of prints out the idea: fair value, significantly overvalued, extremely overvalued, undervalued, you name it. Again, most importantly, based on technicals. While we're looking at this chart, you can see this is a chart where I don't feel like, for me, the momentum triggers would really help me a whole lot. Now, are they probably accurate if I zoom in? Probably. They probably are. I mean, let's take a look, right? However, there's just so many, it's so busy that I'd rather personally look at something larger, right? Like, was this right? Yeah, sure. Was this about right? Yeah, kinda. Is this right? Yep. Is this right? Yep. Is this right? Yep. Kinda. Yep. Definitely. Right? So it's kind of crazy, that the math is right, but it's so much oscillation that you can get chopped up in there if A, you're not paying attention, or B, you're trying to get out of a small move and then you miss the much bigger move because the 3-day bullish oscillation trigger showed up here, and all you had to know was that, and you could have participated in all of this and had a lot less volatility to worry about. So these are things to consider. I talked about intrinsic value and how it's different than rational technical value. Rational technical value is going to be what it is based on the price action, right, and the history of price action. And oftentimes it's going to be very, very valuable. However, I just want to kind of share that if a stock or any asset gets re-rated, let's just say, to have a significantly higher intrinsic value, right? And let's just say it's selling for 7, and then somehow something happens and the world revalues the stock and says, man, this stock is actually worth $45 intrinsically. It's clear from its business dealings that that's what it's worth. Then the rational technical value is actually going to lose its relevance, right? Because what will happen, generally speaking, or what could easily happen, is all of a sudden the price pushes up to 45, and over time, the rational technical value, the technicals based one, catches up and kind of like starts to, monitor its new value based on its re-rating of being worth $45. And so eventually that rational technical value will kind of catch up with what happened fundamentally. It'll catch up to that $45 price, and then it'll start kind of being another, still a good, relatively solid technical way to track, what's reasonable versus what might be a situation where the market is euphoric or the market is just overly fearful. And so maybe then the rational technical value can serve as one point of confluence among quite a few to find, what's real versus what is the emotion of the market. And so if you have a stock that, I have a great one that just in mind where I came up with the the intrinsic value of the stock is actually worth probably about $5.50. And the stock itself, was kind of in fear mode, panic, sell-off, all of those things. Maybe, I don't know if you want to call it manipulation, maybe large institutions sold out quite a bit. So all of a sudden, the stock is in the twos. And I think it's valuable to know, if I know that a stock is worth $5.50 and I feel confident about that, and I also, see that the stock is overextended to the downside and it's selling for, the low twos, when the midterm and macro technical value are, let's just say, 350 and 425, then I can feel much more confident jumping into a position, especially when, significant time frames show me a bullish momentum trigger, right? Like the 2 week or something like that, maybe the 1 month. I can kind of look for that, even in the midst of a crazy downtrend that has lasted for many, many months. And I can look to find an opportunity to enter at a prime place, right? Where not only am I getting a nice discount on the stock, but I'm also jumping in as momentum is shifting for the positive versus the opposite. And if I know that it's heavily discounted right now because people are just scared and it's the mood of the market, when in reality the fundamental intrinsic value is, let's say, $5.50 or $6, well, then I know it might take some time, and there's no, predicting how quickly it'll get there, how much volatility it will encounter on its way there. There's a lot of things that are not super predictable, but I at least have a much, much better idea of when it makes sense to take a position, or to even start, if I want to be safer, to start dollar cost averaging into a position. So these are the things I wanted to share relative to this particular algo. I think it's super awesome, super valuable, and right now, I'm in a place where I'm actually trading this one, and so it's been kind of useful. And I think we're in a place where it's kind of correcting. And, here's the midterm, right? So how often does it hit the midterm? Every so often, right? Here, here, here. So does the midterm say that it's climbing and you're comfortably in an uptrend? Yeah. But at the same time, might this be a decent time to look for a better entry at a minimum? Yeah, because big picture, I'm bullish, and more like small picture, I'm bearish, right? Because I'm fully expecting, based on rational technical value, based on this bearish momentum trigger, based on art of intelligent entry, even just the patient entry, which is the second most aggressive entry in our arsenal, I'm kind of looking for a bit of a correction, right? Even if it's just to there. So if I feel comfortable shorting to there, and if I've identified a way to make money asymmetrically with my risk, relatively mitigated, and defined risk so that I know the absolute maximum risk that I'm willing to take. And if worst case, the position goes completely against me and I lost everything that I'm willing to lose, that it wouldn't really mess with me at all, well then, I go ahead and I take advantage of it. And that's the difference between, a shorter term swing trader and an investor. So my shorter term position would probably be this one or this one, right? These are my take profits, for instance, if it goes that far. However, my longer term position, if I'm bullish on this asset for the bigger picture, right, the multi-month or multi-week, then I'm really, really looking for, this position here, and I'm kind of seeking what's possible to the upside, right? And again, here being my my professional entry, right? So if it goes that far, man, that's the one that I'm really interested in if it happens to get there. And so this is where setting alerts comes into play. I set an alert here, so I'm ready for the orange. Set an alert here, so I'm ready for the winner. Set an alert here, so I'm ready for the professional, and so forth and so on, whatever my strategy is. And then I keep in mind that it's still quite overvalued from the longest running macro rational technical value. Why? Right? Why? Let's take a look at a chart that kind of helps you understand that. So if we look at the 1 month chart, it helps you understand, what's possible with the bigger picture data, right? So I can get rid of, some of these, right? If I get rid of some of these dots, probably makes more sense. And so now I can kind of see, like, how often does it visit the orange, right? And so in a bigger picture, starting from 2016 or so, I can literally kind of see like the time frames and how it can make sense, right? Touch these dots in 2016. I mean the orange, it fell through the orange in 19, fell through the orange in the COVID pandemic of 2020, fell back down, recorrected, and touched the orange there, consolidated, but it needed to come back up to the orange because now it's operating below it. So now it was kind of struggling to break the orange. Touched the orange, came back to it, right? But again, this is like measured in quarters, not hours and days and even weeks, more like months. And so here's one where it got away from the macro rational technical value. Here, all of a sudden, correction. Went as far down as this, had to come back up, right? This was the April tariff liberation day, right? And so now, once again, we're in a place where, as you can see, we are clearly overextended from the macro technical value by quite a bit. And so what's next? What's always next, right? Correction probably to where it is or where it's headed. Even if it's headed to here, at some point in time, this is going to kind of cap out in general, right? Multi-year, always happens kind of thing. And then all of a sudden it corrects, right? Somehow, some way. We don't know how, we don't know when, but we know when we're operating in a place where it's potentially overextended. And we can look at history to see what's possible, right? Here it felt overextended. Maybe we're here and it keeps going for months, right? And so we don't have to be so worried about this. We just have to be conscious of it, that eventually it comes back. Right? And so right now I think we're in a great place because the short, the mid, and the macro are stacked in the most optimal way for bullish behavior. And eventually, just like it happened here, they will kind of shift and be in a state of correction, right? And we could not see this for many months, but it's generally what happens. And even more often, the price action revisits the midterm technical value, right? The midterm rational technical value. So if I were to count how many times it touched the midterm on these charts, it's much more often. Here, touch it here, here, right? Kind of deviated a bit, then touched it here, touched it like almost every month. And then it didn't touch it for, however many months, and then it touched it here, and so forth and so on. And so you can see, like, these rational technical values oftentimes simply serve as a magnet. And so you have to kind of ask yourself, if you're going to go long, how do you protect your downside? And or what might you look for to watch out for when it might be time to go short, right? When might it be correcting? So I think this looks really good. Now we have the benefit of the PMR to kind of keep us, tuned in to what's going on with the markets, small caps, geopolitics, you name it. And I think that's a super, super huge part of it. We have the red flag risk addendum, which calls out assets as far as which ones are tied to the most risk based on what's happening in the world, up to the date that the red flag risk addendum was created. And so that's valuable, that's important. And we also have the market conditions reports. And so when it calls out, in this case, let's say it called out IWM for one thing or another, I can at least go and research that thing. And I can say, you know what, the MCR for TradFi is a technicals-based report. So whatever it's doing, it's based on technicals. So I have to kind of look at it, and then I have to kind of look at my own technicals. And, what generally happens, what do we start looking for when we're at the very, very far corner end of a bias box? Well, we look for a reversal, right? Generally speaking. And it doesn't always happen, but look, this was at one point in time the very top right end of a bias, box. And that's when it happens, right? This at one point in time was the very, very top right of a bias wrap, and that's when it happens. And so how do we do that? Well, we have to realize this is the 1 month, so it gives us a really, really big perspective that, it could keep going, but also this is the highest it's ever been, so potential for reversion to the mean is growing, not shrinking. And then we get to go look at smaller time frames, like the 1 day, right? And that's where it generally starts, right? The 1 day, the 4 hour, you're not really going to have a meaningful reversal without the 4 hour starting it. And so that's the other thing I would tell you is if you're looking for swing trades, a lot of times it makes sense to just simply have a really, really solid understanding of what's happening with the 4 hour time frame. What's the trend looks like, or what does the trend look like? How far overextended do these appear, or does this one even appear on the 4 hour? Because it's highly likely that we will one day visit this, right? So if this is the day you're thinking about making a long, and you have to ask yourself, is this getting closer? How am I looking? And you always want to be careful longing real-time price action that's at the very top. At least want to know what's going on and ask yourself, why is this a smart idea, or why might this be a bad idea? And could I get a better entry? Should I go look for something that's a better entry? Patient, winner, pro, volatile pro, and so forth and so on. So all in all, that is it. And I don't know, I think this may be the CCM, so it's possible it doesn't load, but I just mostly want to show you that generally for a trend to end, the 4 hour bullish bias box needs to be left behind. And then generally speaking, before a significant trend can start, in fact, emphatically all the time, a 4 hour bearish bias box needs to start. And maybe it's a volatile downtrend and they start and they stop, and there's breaks in between the bearish bias boxes, but generally it will start with the first one after a long period of going the opposite direction. It'll start with a new bias box that is kind of showing you the first signs of a potential reversal. So this is a little bit of CCM intertwined in with some art of intelligent entry, mixed in with data on rational technical value, why it works, how it works, and then what the dashboard entails. And mostly I just want to share that it's very, very important you get this right, or else the dashboard will not work the way it's supposed to. I also want to kind of share, you can add obviously the dots. You can add the get ready dots or remove them if you want. These are the yellows. You can keep them or get rid of them. And lastly, the position of the dashboard. And then this allows you to manipulate the sizing, right? So if I go to a smaller size, it shrinks. If I happen to be on my phone, I can go down to mobile phone, right? And it makes it mobile friendly. So while I'm on my computer, I like to have at least this one, if not the large monitor, because I have pretty large monitors. So I hope this helps. And obviously this is the stuff that we like to talk about in the group. So this is the rational technical value walkthrough, kind of sharing, insights on the momentum triggers, bullish and bearish. This is a great, I think tutorial of sometimes when they're busier, it's not as clean of a signal. It still works, but it can be really choppy, and you have to just be a scalper type of person, and you don't want to use it as your single point of confluence. You want to look at the historical accuracy. Did it work? Has it been choppy? Has it not worked so great? If it hasn't worked so great, use your common sense and don't use it. use other things. Look for more, larger term, larger time frame data to give you insights. And if it has worked, then cool, use it as a point of confluence, even though it wouldn't be the single one. And then obviously never lose sight of art of intelligent entry, never lose sight of fundamentals if you have them. Don't ever discount the CCM. And a lot of times the get ready data, it comes out a bit early. So be prepared for it to keep going a bit further. And then when you see the actual bullish or bearish momentum trigger, you know that, okay, now it's pretty close because now it's pending. And then obviously when it actually closes that way, it's kind of cemented itself in time, and that's what creates this historical view, that you can see on any given asset. So you do get to see where it's worked, where it's not worked, where it's had challenge, and then you can kind of decide whether or not you want to use it as a point of confluence based on that. This is, choppy with a lot of different stuff, but as you can see, I can ask myself, did it work? Yeah, kinda. Yeah, definitely. Yeah. And then it kind of caught the short here. So again, these are weaker signals. Smaller dots generally weaker signals than the larger dots. A long inside of a bullish bias wrap is much more valuable and likely to be the direction that, especially if it's just getting started or didn't start that long ago and it's not coming to an end. You got to pay attention to those nuances, but likely to be a cleaner signal for actually getting the direction right than a bearish momentum trigger in a bullish bias box. Right? Generally, a bearish momentum trigger in a bullish bias box is kind of like resetting your longs. And it's like this is still bullish in its bias, so this is just giving you an opportunity to reset your longs. And then obviously understanding and being conscious of where rational technical value is super useful in itself as well, because you know if you're operating in a situation where it's overextended quite a bit or not. So I think I've gone on long enough. This is quite a bit of education here, but it also gave me an opportunity to share a lot of the nuances and the value of the rational technical value indicator and how it's different than intrinsic value, right? There are two separate types of valuation. One is, this is a company, this is how its business is doing, these are its prospects for the future. I crunch a bunch of math, I look at P&L, I look at all the things about the business, and I go, gosh, this is a really undervalued stock based on what it's worth now and or based on what it's going to be worth, in my opinion, in the not so distant future. So it's undervalued intrinsically. Whatever the outcome you get is, that's intrinsic. This is basically technicals. It's saying based on its historical price action, it's overvalued, it's undervalued, it's fair valued, right? It's kind of, and again, based on time frames. So this is just looking at technicals, giving you some perspective on, valuations relative to obviously short term, mid-term, and macro. And to make sure you get those things right, you need to make sure that you have the right setting in use, right? Whether it's a growth stock, a mid-cap stock, a mega-cap stock, a crypto major, a crypto altcoin. I have a lot of different settings in there, and I just want to make sure that people get them right. So I'm gonna kind of close out with that and just let you know I appreciate you. And 1 hour, a lot of information compacted into one session. Hope you enjoy.